It's the weekend and you have financial questions that need answering. That can only mean one thing. It's time for Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
Welcome to Jill on Money. It is the first weekend in June. I am Jill Schlesinger and Mark Talercio is running the show, and we are grateful that you are joining us today. Woof, what a week. Crazy. Unemployment rate, all-time high since the Great Depression. I don't even think they kept real records during the Great Depression, so who knows? But we are in uncharted territory, that is for sure, at least when it comes to the economy. And meanwhile, I know a lot of people just wondering what to do with all this information and how to manage their financial lives. Well, we are here for you. And that is why we do this show every single weekend. We want to understand what's going on, and we want to try to help lead you through these uncertain times. If you have a question, send us an email. Ask Jill at jillonmoney.com. Oh, I almost forgot to mention that we are broadcasting from the Capital One virtual studios. Capital One, what's in your wallet? By the way, Mark, it's always funny how, like, during a disaster, remember, like, just 2 months ago, the market was cratering down, 30%, the stock market. And everyone was asking us, where do I put my cash? Where do I put my cash? Funny, those questions seem to be tapering off a little bit. Are we all suffering from a little investor amnesia? Don't walk away from this whole experience not understanding just how dangerous it is to be an investor, not just now, but all the time. This is the lesson to be learned. You do not want to walk away not understanding that this is not a game. This is not an avocation. This is not like walking into a casino. This is your real life. Okay? So, all right, let's get to some of your questions. We received an email from someone who was awarded a large lawsuit settlement. With the settlement was over $400,000. $370,000 was taxable. Okay, so here's the background. It was a 27-year-old was awarded this money. And they basically, the family has basically said, we would like to avoid the big taxes because essentially most of this, of the 415, 370,000 is taxable. So how do we avoid that? So unfortunately, the 27-year-old was recently laid off. And the only big debt he has is his car payment. He's got some smaller medical bills, no credit cards, recently engaged, expecting a child in December. Okay. So all he has to do is take about, let's say, 10 grand of the 411,000 and pay off some debt and get the car. Okay, that's good. He's just moved back home. He's looking for his own place, a new job. We don't know much about investing. We're taking classes to try to learn. God bless you. He's waiting for his unemployment. So I was an active participant in the lawsuit, and that's why I am involved in helping him direct the money. Okay, so here we go. A 27-year-old who receives this money. Let's think about what has to happen. The guy's got no money, right? So what does he do? Number one, let's just do the math. He's going to get taxed, but in a weird way, his situation is probably, he's in the best possible situation to have to pay that tax. Yes, it's a ton of money, right? No doubt. So he is going to, as a single person, I don't know when this is going to be for tax year 2019 or 2020, he's going to have to pay these taxes, right? But he doesn't have any other income, so he's going to pay a bunch of taxes. Okay, pay the taxes. Don't worry about it. There's no way to really defray that. So here's what you're going to do. Of the 411,000, you pay for the car, you pay down the debt. Now you got 400 left. Next, make sure that the money that is taxable, right, the 300 and some thousand, that you've set aside the tax that's due. And, if you don't know what that is, we could probably do like a back of the envelope calculation. But my guess is, you're going to want to keep a good $100,000 set aside for taxes for next year. And you may be able to actually get that, get the number if you want to. There's probably a calculator you could use. But let's just presume that Of the 411, you need $100,000 for taxes. Okay. Now, that $100,000 should go into a short term CD, meaning that it's got to be available to pay the taxes next April. So that would be something like, maybe 9 months. It's fine. Stick it in a CD. That's your tax money. Okay, now we've got 300 left. Of the 300, he's got to figure out how much money he needs in order to live. And whatever that amount is, think about it that, he'll need a year of his living expenses. Okay. Then what I would say is set that money aside in a high paying savings or money market account. You can go to depositaccounts.com. I don't know how much that will be. Let's presume that if you've got 300 left, maybe he's going to need another 50,000. Maybe it's going to be 100,000. I don't know. But whatever it is, set that aside. Do not touch it. What remains, this, let's call it about $200,000, that's what we're talking about for your investing and for his investing. And what I would suggest is this, that he go very slow. And I think that what might be really helpful in this situation is to say, all right, well, let's be really conservative. And of the $200,000 that's left, maybe what we'll do is we'll go into a online investing platform, and that's a really good and effective way to manage your money. What are some of the names that you should consider? Schwab Intelligent Portfolio, Vanguard Personal Service Advisor. That's Betterment is another organization that you can try. This will be a process where you can do it online. They'll take $200,000, but they'll put your son through paces. Okay. That to me is the way you should really navigate this as conservatively as possible with a little help. It's good to take classes, it's good to help guide him, it's good to dive in. What wouldn't be good is to kind of learn on the job when it comes to this kind of investment. This is I presume, a once in a lifetime kind of settlement. And as a result, we don't want you to squander it. On the other hand, what I also don't want someone to do is some broker or salesperson sell you some crazy ass product that you don't need. And so that's why I am suggesting getting some help. But, the help is really going to be important. The help, I think, to be as cheap and effective as possible should be an online advisory service, also known as a robo advisor. So this is what I think you should be doing. If there's any follow up and you need more help, I'll take a third email. That's fine. But we just want you to be really careful. Have your guard up. Don't worry too much about the taxes. Pay off the debt. Set aside money for emergency reserve. Set aside money for taxes. And then whatever remains, that's what you are going to actually invest. Don't go crazy with the risk. This is a big chunk of money. You don't have to risk it all at once, nice and slow, okay? If you've got a financial question, we would love to hear from you. Just send us an email. It's askjill@jillonmoney.com. You can always go to the website, jillonmoney.com, and there sign up for our free weekly newsletter, or maybe buy our book, The Dumb Things Smart People Do With Their Money, 13 Ways to Right Your Financial Wrongs. Okay, we'll be right back.
Back to Jill on Money, where Jill Schlesinger helps you take the mystery out of your finances.
You're back. It's Jill on Money. This is the show that attempts to take the mystery out of your financial life, and it has been bumpy. Woof. Boy, oh boy. Right back to, March, April, May. 3 solid months of just unbelievable movement in financial markets, in cratering of the U.S. and global economies, fear about coronavirus, safety measures, government programs, enhanced unemployment, just everything. It's been exhausting. And if you're having a hard time keeping track of everything. And if you're having a hard time just navigating your own financial decisions amid this lockdown and soon to be reopening economy, then why don't you give us a holler? We have an email address that is very busy lately. Ask Jill at jillonmoney.com. And if you're on our website at jillonmoney.com, there is also a contact button. Okay, Kirsten is she wrote a follow up, but it's basically she really wants to know about her family's financial plan. Okay. And so here's the background. Kirsten's husband makes $67,000, and she says he's got the ability to move up to probably about $80,000 over the next 2 to 3 years. Kirsten is making $50,000 this year, but going to jump by going to almost double, going to $90,000 in August of next year. So let's just think about this, gang. So right now they're making about $117,000 this year, but in the next couple of years they're going to be making more like $170,000. Okay. $40,000 in federal student loan debt, the interest rate 5.5%. $4,000 in a general savings account. There's $2,000 in a Roth IRA. Now, Kirsten says she's got no retirement savings at this point because she's been earning her PhD for the last 7 years. Oh boy, that's a lot of school. Okay. Kirsten's husband's got $12,000 in his retirement fund, 6% employer match. But my husband actually contributes 12% now to a Roth 401k based on your suggestion. Okay, now here's the question, the game plan. We're debt averse. We would like to prioritize paying off the $40,000 in student loan debt. I'm on board with that. 5.5%, that is a big number. And right now, in order to get a 5.5% guaranteed return, you can't find that. So yes, I totally agree. Prioritize paying down that student loan debt. Okay, next aspect. They would like to start a family in the next 3 to 5 years, something else to consider. General goals, they'd like to save up about $80,000 for a down payment while also saving for retirement and saving an emergency reserve fund. What is your suggestion on how to tackle paying off the student loan debt, saving up in the short term for the home down payment, and contributing enough to a retirement plan, given that we're both around 30 years old and just starting to invest more seriously after being in grad school? All right, gang, here we go. So, first things first. Right now, you guys are making $117,000. I think you should go through the way that you are spending your money. You should really itemize and go through that process. And maybe it's through mint.com. Maybe you write it down. I don't know. But on your $117,000, what is available to fund your goals? What is that amount? I don't know what it is. You have to tell me that. But let's make it up. Let's say that every month, based on what you're telling me, that you have let's call it $1,000 every single month. Okay. Of that $1,000, what I would be doing is I would take half of it and pay the student loan debt, and the other half, I would put it towards building up your general savings account to that emergency reserve fund. Okay. That's how I would do it. And I would make sure that that was my priority. Those two things, student loan pay down and emergency reserve fund, those are your two priorities. Yes, your husband can absolutely put money in his retirement account. And when you have more money to put away, then I certainly think when your salary goes up, you can try to put money away. But for, let's call it the nearest term, which is 1 year game plan. 1 year game plan, half to student loan debt pay down, half to your emergency reserve fund. Now let's wind the clock up to August of next year. Now you're making more money. With that, what I would do is I would add the third component, which is putting money into a retirement account for you. So whatever that funding amount is available for your goals, then I would make the distinction and say, put some money in a retirement account for you, keep paying down your student loan debt, keep funding your general savings account. Have you noticed what I've not actually mentioned in terms of these funding goals? Yeah, the house down payment. Don't do that. Do not do that. In fact, what I would be doing is I would be paying down my debt, getting my emergency reserve, and both of you investing in your retirement accounts, probably by, 10 or 12% each for both of you. And then you can start saving for a house. Do not save for a house now. That is like in your back burner. Your front burners, let's say you have a 4 burner stove. First two, debt pay down, emergency reserve. Back to your retirement account, his retirement account. You only have 4 burners on your stove. You don't get another two. Sorry, you're not buying this big 6 burner stove just yet. Everything else will come. This is great. It's fantastic that you're on top of this, but I really need you to hear this. Saving for a house right now does not make a ton of sense. You are in a very strong financial situation as of, let's say, in the next couple of years. Let's see how things go. Let's make sure these numbers hold up, but let's not rush the house. Are you going to hate me for that? Keep renting. Keep renting for now. You'll be okay. All right. Here is a note from Richard who says, love your work and I enjoy listening to you on WCCO 830 radio in Minneapolis, St. Paul, and watching you on WCCO TV. Thank you. He also, by the way, likes my occasional New York Islanders commentary. All right. I only talk hockey in certain markets. All right. Richard writes, my daughter is just graduated from college. She'll be making loan repayments by Christmas time. She's got a Sallie Mae loan, which is $20,000. Check out this interest rate, Mark, 9.375%. Oh my goodness. That is really high. Okay. What are the pros and cons of refinancing? What question should I be asking? Is it simply a better interest rate or hidden benefits in Sallie Mae that we may not want to give up? Hey, I don't think that Sallie Mae loan is actually giving you any benefits. It's not a federal loan. That's not a federal loan. But what I would do is I would start shopping around and I would try to lock the interest rate in at a fixed rate. So that's what I would do. I don't believe this is a federal loan because if it were a federal loan, it wouldn't be 9.375%. It would be a rate that is much lower, probably 5.5%, 6%. Now is a great time for her to do this. I would encourage her to get busy, especially right now with interest rates low and with a lot of companies out there vying for her business. I would suggest you check out Common Bond. That's one place. SoFi, that's another. Just any place where you can get a fixed rate loan. Try to see if she can get a fixed rate loan for 10 years. That's what we're looking for. Fixed rate, 10 years, and then she'll be done. Thanks so much for writing in, Richard. We really do appreciate it. Keep listening to WCCO. All right. When we return, we're going to take more of your questions. And by the way, during the break, why don't you subscribe to our sister broadcast? It's a podcast, and it's called, conveniently, Jill on Money. You can get it on Apple or Spotify, Stitcher, radio.com, Google Play, anywhere else you find your favorite podcast. And if you don't have a favorite podcast, this will immediately become one of them. Okay, we'll be right back.
Do I invest here? Should I put my money there? Jill Schlesinger can help you. Back to Jill on Money.
You're back. It's Jill on Money. And if you've got a financial question, we'd love to hear from you. It could be an investment question. Maybe it's an insurance question. Maybe it's an estate question. I wrote a lot recently about estate planning amid the pandemic. Got some really interesting emails from friends, relatives, one of whom made me laugh out loud, like took a picture of the column, sent it to me, and said, can you send me a free book? I said, it's going to cost you more than a picture of the column I know I already wrote. But thanks anyway. So no, there's no free books right now, ladies and gentlemen. There's no free lunch and there's no free books. Got it? Good. All right. If you've got a question, though, we'd love to hear from you. That's free. You can do it so easily. Just send an email. Ask Jill at jillonmoney.com. Okay. Now, Kenny writes, I love your podcast. I discovered it a few weeks ago. All right, Kenny. I listen to you daily. I'm grateful for what you do. And he writes, you are awesome, which is always a funny thing to read about yourself. But I am very grateful when you send those notes because, as Mark knows, I have very thin skin. So I react to when I get negative ones, which Mark never sends me. But it is also how I've gotten off social media. So that's good. Okay, here is Kenny's situation. He's 66. His wife is 65. Oh, happy birthday to your wife. I retired in February and was really forced to leave my work. And my wife is also retired. Okay, here's what they have in retirement savings. I'm going to round up the numbers. IRAs, 600 grand, 401k, 180 grand. They've got variable annuities. Kenny's is about 235,000 and he's drawing $16,750 annually. So he had an annuity, a variable annuity in a qualified account, meaning it was a retirement account. He is now annuitized that contract. He's getting a check and he gets $16,750 for 14 more years. His wife also has an annuity, 23,000. Both of these are qualified. So basically in money that hasn't been taxed yet, $1 million. Then money in a brokerage account, money in has a money market account and a checking account. And that is 120, 130, about 135 grand. Expenses, $4,300 a month. Mortgage, not bad. 74,000 bucks, 3.5% fixed rate. Payment is $526. That's great. No debt, no other debt. Car's paid for. All right, but here's the issue. Kenny says, I was planning on waiting until 70 years old to sign up for Social Security, but when the market turned lower in March, I went ahead and signed up. Here's what we're drawing. Basically about $2,900 for him, $1,200 for her. It's about $4,100 monthly. Okay, so here's the deal. Right now, they have $66,000 annually, right? And remember, the expenses much lower. He's only at $4,300 a month. But when he turns 80, that annuity income's done. So here's the questions. Would you purchase another annuity for protection and income for our later years when our current annuities run out? No, you should not do that. 2, do you think it's a good idea to convert some of my IRAs to Roths since we don't have Roths? Let's see. I'm just looking at the income to try to figure this out. I don't know. It's not a bad idea. Maybe a little bit. Maybe I wouldn't go crazy. But I mean, the thing that is hard is that what I would say is you've got the IRAs, right? You could convert a little bit each year to make those Roths. And there's 2 ways to approach this. One is to say, oh, I want to stay in the 12% tax bracket. That's where up to about $80,000. So maybe just 14 grand a year and you convert that much. The other approach might be to do a little bit more and, every year and jump up to the 22% tax bracket. But I think that maybe just do a little bit a year. I'd stay in the 12% bracket. It's nice and low. That's a good kind of a good bogey. Maybe you take out, let's say, 12, 14 grand a year. You have that taxable income. You pay the tax with the money that's in your money market account, but slowly but surely you have a little bit more money into the Roth environment. So it's already been taxed. Okay. Question. Should I reconsider Social Security and wait until I'm 70 to start? I know I have a year to make a decision. I can pay them back and reset. I would have to draw down my investments instead of taking income from my Social Security if I did this. We're both in good health at the time. Mark, what do you think? You want to go back and redo it, or should we? Because at 70, he's getting $2,900 a month, and if he were to wait, he's 66. If he waits 4 years, then it's $3,700. But then you got to spend down some of your money. Nah, I think you're going to stick with what you have. Okay, 4th question. I have a current financial advisor. I'm not satisfied with him. If I leave him, do you think I need to hire another advisor and pay a fee? I've talked to an advisor that I go to church with. He seems to know his stuff. He's not a CFP like my current advisor. He told me he would help me manage a small portion of my portfolio. Uh, he's a registered investment advisor. That doesn't mean anything. I don't think you need, I'm not sure you need anybody. Mark just pointed out to me something that I am very intrigued to at least consider, and that is that um, Vanguard has just launched a full on, when I say full on, meaning with no advice at all, a digital advisor, a financial advisory service, a robo advisor. You may want to check that out. Or you may want to check out the service that Vanguard offers with somebody to hold your hand, which does include a CFP. But I don't think that you really need an advisor because you have most of your questions answered. And in some respects, Kenny, having that advisor and having that extra fee is just money that will flow to your bottom line without. So I don't know. I'm thinking you may not need this. I think you're in good shape and convert a little bit at a time. That's fine. And if you need help managing your money, use a robo or an online platform. Well, that could be Vanguard, that could be Schwab, that could be maybe you could even just use, say, Fidelity. I think they also have a service. Check it out. Do a little nudging around there. Do a little investigation. I don't think you're going to need anybody, and you'll be happy to have saved the money, which is really great. All right. Kenny, thank you so much for writing. Really appreciate it. And if you have a financial question like Kenny, why don't you give us a holler? Our email address is askjill@jillonmoney.com. That's askjill@jillonmoney.com. When we come back, guess what? More of your questions. It's very exciting. All right. We'll be right back.
401ks, IRAs, refinancing, she covers it all. Back to Jill on Money with Jill Schlesinger.
You're back. It's Jill on Money. This is the program that tries to take the mystery out of your financial life. And boy, this is some kind of headline here that I got from Gladys, who wrote in her subject line, "I think my finances are starting to look ugly." Here's what we got. Okay. I'm a 40-year-old accountant from Puerto Rico. I work for a food industry corporation and my husband sells truck parts. We have a 12-year-old daughter. Last year, we bought a second home. We moved in last September. We haven't done anything with the old house yet. In fact, we're not sure what to do with that old house since the values in Puerto Rico have been going down, and we don't know whether we should rent it or sell it. Ugh, I'm sorry. That's always a drag. Okay. The old house, she's got a mortgage, $500 a month. New house, $1,300 a month mortgage. Ugh, we're paying for both houses. It's starting to bother me. Okay, I make, Gladys says, $49,000. My husband works minimum wage plus commission. He's been making $70,000 a year after their 401k, his 401k contributions. Okay, so that's pretty good. She says, I have $96,000 and my husband around $70,000 in our 401ks. Okay. She's got $13,000 from an inheritance. It's in a credit union, $7,000 in other bank accounts. They owe $8,000 in credit cards and a pickup truck we bought last year that we pay $490 a month. Should I take cash and pay off those two credit cards? Should we sell or rent the old house? Also, I was thinking of taking a loan against my 401k for about $10,000, but I'm not sure. We used all the cash we had until August to pay for the down payment, closing costs of the mortgage. Now we don't have the money to make the renovations because all that money was possible due to the small amount we had to pay for the old house. Okay, the world is starting to change. I don't know what I should do. I don't feel comfortable. I would appreciate your advice. Very warm greetings from the Caribbean. All right, here's the deal. Number one, I want to know how much you could sell that house for, because my feeling is that it's very bad to be in a situation where you own two homes and you're hoping for real estate values to rise. That is just not a great game plan. So my inclination is number one, sell the house. And presuming that you've got more equity in the house than the mortgage, I would then take whatever the proceeds are from that house and take a deep breath, put that money into your savings accounts. And then from there, if you have an extra $8,000 from that, I mean, I'm presuming you can actually find the money from that sale and have extra money. If you can do that, you're going to pay down your credit card first. You also didn't tell me how much money is the truck loan, because what I would do is, in order, I would pay down. If again, this is only if there's money, there's equity in your home and you can sell it. If so, it's paying down the credit cards and it's also then paying off the truck. Okay, let's presume you just break even on the old house. That's fine too, because now you've got an extra $500 a month. Now take that $500 a month and use that to accelerate the pay down of the credit cards. Okay, that's number one priority. So don't use the cash that you have saved. You may need that cash. But if you can sell the house, even if you just break even, the $500 a month that you don't have to pay goes into paying off the debt, then paying off the truck, and then goes into making sure that you build up your emergency reserves. You will feel better when you have extra money that is in your savings accounts. All right. Then what you're going to do is, once you have those bills paid, the credit card and the truck, you're going to take that. Now you're going to have not just the $500 a month from the old mortgage savings. You're going to have about the $500 a month from the truck and whatever you're paying in the credit card. You're going to take that $1,000 and you're going to put it into your accounts. You are going to build up that cash, and then you will be able to start slowly saving the money that you need to renovate the new house. Okay? You guys, this is not like a, oh my God, break the glass. But you are on the verge of potentially getting stuck in a bad situation. So I want to enter into this situation right now with you and try to help you walk away from the edge of that financial precipice and build from here. Okay. So if that makes sense to you, but if you want, you can let me know. Again, the most important pieces of information that I would need to really help you beyond this would be, I want to know how much is the house worth? What's the mortgage outstanding on the house? I want to know how much is the truck loan? What is the outstanding balance on the truck loan? If you give me those pieces of information, we can follow up more succinctly. But that's the basic premise. Okay, Gladys? Thank you so much for writing. I think we're close here. I think we can help you right now avoid a big problem. I know you might want to think about pulling money out of your retirement accounts. I don't think you're going to need to do that. I want you to refrain from doing that if possible. Okay? All right. You're listening to Jill on Money. When we return, more questions like this, more of your questions. We want to help you walk away from that financial precipice and get back on track. It's Jill on Money. We'll be right back. You're back. It's Jill on Money, and we are broadcasting from the Capital One virtual studios. Capital One, what's in your wallet? The virtual studios has worked out pretty well for me and Mark. We had gone virtual prior to the pandemic. So this was just our backup system while Mark was juggling his daycare responsibilities for his son. But luckily, here we are. serving you and all of your needs. Okay, before we finish up this hour, I want to get to another question. Remember, if you have a financial question, all you need to do is send us an email. Ask Jill at jillonmoney.com. Pam writes that she is planning on retiring next June after being a school teacher for 43 years. God bless her. Okay, she says, being a single mother, there isn't a lot in the bank. I will have Social Security and a modest retirement totaling around $3,000 a month. Great. That's great. Mutual funds and Roth IRA, $300,000, though it's shrunk in the last few months. I bet it's come back. Okay, question from Pam. I currently rent and I'm wondering if I should buy a place. I live in Seattle. It has gotten ridiculously expensive. Oh, Pam, let me take you off the hook right now. Do not buy. Do not even think about buying. Continue being a happy renter. I actually dedicated an entire chapter of my book to you. Well, not to you, but to people like you, which is one of the dumb things that smart people do is they buy instead of rent. Renting is perfect in your situation. Don't worry about it. Don't burn up the money that you have. You need that liquidity. You've got some ample resources. You've got recurring income. Great. Keep that going. Do not buy a home. You can pass go, but you are not allowed to buy either a hotel or anything, even if it's one of those crappy properties, you know. Mark, do you remember the crappy properties in Monopoly? Were they the blue ones? I forgot which ones they were. I think it's the blue ones. All right, we'll have to figure that out. We might be playing virtual Monopoly with you. Okay, when we return next hour, we've got a great interview lined up. We always like to give you a little treat here on the weekends. It's Jill on Money. Hop onto the website, jillonmoney.com, and you can always email us right from there. There's a contact button in the upper right-hand corner. Okay, we'll be right back.
It's the weekend, and that can only mean one thing. You're listening to Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
Welcome, welcome. It's hour number 2 of Jill on Money, and we are broadcasting from the Policy Genius virtual studios. Policy Genius is the easy way to compare and buy insurance. Just go to policygenius.com. Well, we've got a wonderful treat for you today. We have one of the pillars of financial writers, personal finance, but also I think sometimes he dives into some other really interesting aspects of investing. His name, Jason Zweig. You've probably read his column in the Wall Street Journal called The Intelligent Investor, or maybe you've actually read some of his books. One of my favorites that he did was The Devil's Financial Dictionary. It's very cute. But, you know, he's done a ton of different stuff. His take on how to manage your financial life is really spot on. And so I want to, if you've never heard an interview with Jason Zweig, you're in for a treat. This is something that we recorded a few years back, but we wanted to bring back to you because so many of the concepts that we cover are more important than ever in this current environment. So here is our interview with Jason Zweig. What's the best money decision you have ever made?
Well, you couldn't give me a warning on that one.
No,
so
of course not, because you know how it is. It's like live TV. We don't give you the questions.
I have to think about that on the fly.
Yeah.
The best money decision I ever made, I think I would have to say, was partly the result of serendipity and partly a good decision, which is that during the financial crisis in 2008 and 2009, I was working at the Wall Street Journal then as now, but I had a fair amount of outside income coming in from some unrelated things I had done. And it was a sizable amount of money in the scheme of things in our household. And I had long had a rule that whenever I got any additional cash, I would always invest 1/3 of it. And some of these checks were very substantial by our standards. And I hesitated, and then I said, no, I have my rule. So I took 1/3 of everything that came in, and I put it into into the index funds that have long been the core of my portfolio. And when I looked back recently, I realized that the money that I had put in during 2008 and 2009 had grown just to enormous size. So it was partly luck, and it was partly a good decision.
But it's I like the idea that it's not really luck. It's actually you force yourself to adhere to your system, which is pretty awesome.
Yeah, I think rules are just of huge importance. It helps when they're good rules. If you live your financial life by bad rules, you will get a bad result. I developed that rule, by the way, back when I was the mutual funds editor at Forbes magazine. I was walking down the street on my way to meet some friends of mine for lunch, and I stepped on what felt like paper, and I looked down, and in fact it was money. And I stood there for about 5 minutes to make sure the rightful owner didn't want to reclaim it because it might be somebody with a gun. And I took my foot off it eventually, bent down, picked it up, and put it in my pocket. I went into the restaurant where my friends were waiting, the diner, and I said, I just found something. Let's see what it is. And I pulled it out, and if I remember right, it was it might have been $5 $100 bills. And what ended up happening was, of course, I bought lunch for all my friends.
Yes, but thankfully you were at a diner.
We were at a diner, and it was around 1990, so it wasn't a lot of money. But I ended up spending at least $100 more than the money I had found because of the windfall mentality. When money lands in your lap, you feel you can spend it all and sometimes then some. And that's where that rule came from. I said if I ever come into money that is outside my paycheck, I'm not going to treat it like a windfall. I'm going to treat it the same way I would treat labor income, which is to really be careful with it.
So talk a little bit about your career and what has happened in the industry as you've been part of this. How'd you get into this?
Well, I got into financial journalism more or less by happenstance many years ago when I first joined Forbes magazine, which was right after the crash of 1987. And I quickly realized I liked it. And after about 5 years, I became the mutual funds editor at Forbes. And in the first 6 weeks I did that job, I think I got more mail from readers than I had in the previous 6 years of all my other roles. And I realized people care about this stuff. Maybe some people care about it more than they should, but they care about it.
In 1987, in the aftermath of the Great Crash, what was it like in the mutual fund world? What was going on then?
Well, the whole investing world was sleepier and more primitive and a lot less sophisticated than it is today. In the late 80s and early 90s, investment management firms were really in the business of trying to figure out how to get people to buy stuff that was bad for them and good for the investment companies. So what ended up happening was people got income or yield, meaning every month they would get some check from a fund company or investment firm without noticing that their principal was disappearing. So they might have put up $5,000 or $10,000. Maybe they got a couple $100 a month in income, but the money they put up in the first place was disappearing. And a lot of these people lost much, some of them lost most of what they put in because we didn't yet really have a thoroughly fiduciary culture. Not that we do today, but it's better today than it was then.
At that time, did you personally believe the concept that, you know what, there are stock pickers out there and someone can beat the market? Did you have that sense when you walked into that job?
Oh, yes. Where my thinking has evolved from 30 years ago is that I've really come to believe that one of the single hardest things any investor can do is not to pick securities that will outperform the market, but to pick the managers who can pick securities that will outperform the market. I think that's much harder. I think it's easier to beat the market than it is to find someone who can beat the market.
We'll get back to our interview with Jason Zweig in just a moment. Hey, during the break, here's an idea. Why don't you subscribe to our sister broadcast? It's a podcast, and it's called Jill on Money. You can get it on Apple or Spotify, Stitcher, radio.com, Google Play, anywhere else you find your favorite podcasts. We'll be right back.
Back to Jill on Money, where Jill Schlesinger helps you take the mystery out of your finances.
You're back. It's Jill on Money. And so often when we do this show, we do tend to home in on some pretty core investment concepts. One that you hear me talk about all the time is this concept of how do you decide whether you're going to be a great stock picker or mutual fund picker? Should you just buy an index fund or an exchange traded fund? Let things passively go along as they go along. And sometimes I feel like if I say it over and over, it might lose some of its oomph, because I'm a huge fan of passive investing. Well, that's why I'm so delighted that we have our guest, Jason Zweig. He is a columnist in the Wall Street Journal, The Intelligent Investor. He has been covering financial stuff for years. And Zweig was one of the early proponents of the personal finance and financial writers who talked about passive investing and how important it was. And so what I think is great is to hear in his words break down this age-old battle. Well, maybe it's not an age-old, but a 50-year-old battle about which is better, active or passive investing. Let Jason Zweig do the heavy lifting on this one. Here's more of our interview with Jason.
Investors and the financial advisors who help them should make a clear distinction between what people ought to do and what people can do. And there's no doubt in my mind that the vast majority of investors ought to have their entire portfolios run passively by machine in index funds without any or without much application of human judgment. People would be vastly better off if they did that. That's what they ought to do.
Okay.
Can they do that? I doubt it.
Really? Because I think, well, what's the whole idea of the money that's flowing into index funds and passive funds? Do you think people are just going to still muck around with it once it goes there?
Yeah, I think a lot of people are doing the right thing for the wrong reason, which is a huge problem in the financial markets and the investing community. You know, in the short run, you can do quite well when you do the right thing for the wrong reason. But in the long run, if you're doing the right thing for the wrong reason, you won't be able to stick to your plan because you don't really understand why you're doing it in the first place. So my view is that for most people, what you should do, what you ought to do, is what you can do, because then you'll stick to it. And I think what most people can do is they can put most of their assets in passive funds, just tracking market indexes, and then they're going to need a little fund money to play with.
Yeah, I mean, I think that makes sense. A number of years ago, early in the automatic investing platforms coming out, I wrote a big article about it in my Tribune column. And I got some real significant hate mail from the advisor community.
Of course.
Like, you are one of us, and why are you
Right.
putting us out of business now? And I maintained then, and I maintain today, that using that platform, whatever it is, that just kind of puts the investing on the autopilot, even so that the advisor doesn't muck around with it, can then focus the advisor on doing the things that humans do really well, which is like, I'm listening to Jason tell me about his aging parents.
Yeah.
Like that's something that I do need a human to do.
Correct.
And I really don't understand the pushback from the industry, because in some ways it's like this, every time there's this little friction point in the business, they fight it so hard and they look like idiots for fighting it, right? Because then you come back and you say, well, why'd you fight it? You're good. Remember, I'm sure you remember this. I remember when we were talking about online trading, it was going to be the death of Wall Street.
Right.
Right? I don't think so. They seem to have made quite a bit of money in that business.
Yep. Well, I think it's sort of the inevitable cycle of progress in any industry. I mean, there's a much more important question that consumers should be asking, which is, if my financial advisor feels so threatened that a computer could put him or her out of business, maybe I need a new financial advisor.
Yeah, no kidding. So let's get into that a little bit. We're talking to Jason Zweig, a personal finance columnist, author of The Devil's Financial Dictionary, which may have like the best cover ever for any financial book, because there is a devil in a suit. Sort of like whatever Lolo wants, you're going to get in that investment advisor right there. I guess that since we're talking about the devilish financial, so let me just say, I will come out and tell you that as someone who came out of the financial services industry, what I often will say is I think of financial services, especially investment management side of the business, like a drunk relative. That I'm related to this person, I love this person, I admire this person, but man, when that person misbehaves, it's freaking ugly. And so
and he needs help.
And he needs help. And he
can't admit it.
Exactly. That's to say, he needs to start by admitting he has a problem. So considering that this, I think you're taking this as your metaphor as well, what can the consumer do to help navigate this devilish industry?
Well, the first principle, I think, is that, everyone wants to get advice from a trusted friend. And it's so important as a consumer for you to be able to trust your financial advisor. But I think you have to recognize that trust should only go so far. You should trust your financial advisor to be honest and serve you appropriately, but you always have to be on your guard. And you need to be an intelligent, informed, skeptical consumer, because even the best financial advice can lead you astray some of the time.
The price of trading, of executing an order, is pretty much going to zero. The cost of index mutual funds heading towards zero. What do you see is on tap next for the financial services industry?
Well, I completely agree. Last year we had an article in the journal that I was involved in that was called "The Race to Zero," and I think it's worth just pausing for a second, Jill, and because I do have I've been in this business long enough to have an institutional memory. In 1992, when I became mutual funds editor at Forbes, and come to think of it, it'll be 25 years ago this coming summer. I think the first article I ever wrote that mentioned index funds, I mentioned what today is called the Vanguard 500 Index Fund. And then I think its annual expenses were around 0.5%. It's phenomenal how costs have come down. And the thing you have to bear in mind is that as costs come closer and closer to zero, there becomes less and less room under the curve, and the competitive pressure is going to become a lot fiercer, because for every basis point, each hundredth of a percentage point that the investment firms still have, they will fight to keep that more and more viciously because their profits are continuing to shrink. So the competition we've seen so far, I think, is nothing like what we're going to see between here and zero. But eventually, I think the cost of funds and portfolios very well might literally be zero. It might be free. It might be a free good. And that's going to put enormous pressure on the people who provide advice to provide advice.
Right,
and,
not to just sell stuff.
Right. And 25 years ago, 15 years ago, 10 years ago, and to a large extent even today, all too many financial advisors equate advice with fund selection. Like, you come to me for advice, oh, well, I'll tell you which funds to buy. That's not really the advice consumers need today.
We'll get back to our interview with Jason Zweig in just a minute. Hey, here's an idea. During the break, maybe all you ought to do is just follow us on Twitter. How about that? @JillOnMoney. I know, Twitter's a cesspool, but not the stuff that we tweet. Check it out, @JillOnMoney. We'll be right back.
Do I invest here? Should I put my money there? Jill Schlesinger can help you. Back to Jill on Money.
You're back. It's Jill on Money. And we are in the middle of a fantastic interview with Jason Zweig of the Wall Street Journal. Great author, great columnist, and just cuts through so much of the crap of the investment world. And we are replaying an interview that Mark and I taped some years back. I can't remember when, because so many of the issues that we cover were just so relevant today. And, you know, this is a few years ago before we saw all the big houses cut their commissions to zero. But this is just Jason Zweig being as prescient as ever in that he basically is saying, hey, you know what? You really have to understand what the cost of your investing is. And once you start to see that, once you see that you can essentially pay zero, you then have to start asking yourself, well, what am I getting when I pay more than that, when I pay more than 0.1% or 0.15%. That, of course, gets into the active versus the passive, which we just covered in the previous segment. But it's always a delight to have someone else reiterate all the things that I've been trying to articulate to you guys. So here's more of our interview with Jason Zweig. What encourages you about the financial services industry right now? You've been covering it now, as you said, for almost 30 years. And what is it that makes you happy about it?
Well, I think there's a few things. One is slowly we are migrating toward a fiduciary culture. There's a lot of signs of that development. It's slow. It's going to be 2 steps forward and 1 step back. But it's coming. It's inevitable. It's sort of like the wind of change. And it's not reversible, in my opinion. The second is that low-cost revolution we talked about. I mean, when I first became aware of the financial markets in, I'm going to say, 1975 or 76, when I was in high school, typically our family was not unusual. I mean, if we wanted to know the price of a stock, we'd have to wait a week until my dad subscribed to Barron's for a while. Barron's would show up on Saturday. Then he would find out one price over the past week.
Parenthetically, my father also ritual Saturday morning, went out and got his Barron's.
Yeah.
Unfortunately for our friends over at Barron's, including my buddy Jack Otter, I said, too bad that's your demo still.
Yeah, exactly.
We got to get some more people.
Exactly. But so, and if you wanted to do a trade, you wanted to buy a stock, you had to pick up the telephone and call your broker. And in those days, it was what was known as a long-distance call. There was a thing on your table that was kind of shaped like a pyramid, and it had this round thing on it. and you would stick your finger in it and you would dial, and it was called a telephone.
A rotary phone.
A rotary phone. And that call could easily have cost you $2 or $3 in 1975 dollars to call your broker.
It's a real number.
It's a real number. And you would wait 3 to 7 days to get the little slip of paper in the mail that told you your trade had gone through, and you would have paid a commission of, depending on the stock, maybe 2 to 4% to buy it.
Right. That one transaction.
And today, you can buy shares of anything you want for well under $10 and often for nothing. Although your broker might still be nicking you on the spread, but it's still, you're at least 90% better off than you were 40 years ago. So the low-cost trend is hugely exciting. The other thing that I think is really, that bodes well for the future, is there are so many smart people in finance now. I mean, in decades past, and Michael Lewis has written about this quite a bit too, Wall Street was kind of a refuge for people who kind of needed something to do when the golf course wasn't open. So they would go and sit on a trading desk, or they would go and run a mutual fund.
Or sort of a dilettante-esque.
Yeah, and everybody seemed to have a name like, Winthrop Saltonstall IV. And I have nothing against white Anglo-Saxon Protestants, by the way, but it was a sleepy, sort of intellectually lazy, hereditary kind of culture where nobody really thought about the customer, and to the extent that people did, they called them customers. They didn't call them clients. They called them customers. Brokers were called customers men.
Right. He's a customer man.
And I mean, think about that, and
Yep.
and the significance of that. I mean, it was a sales-driven, insular culture that didn't really value the people it was there to serve, and we're a long way from ideal. But we've also come a long way from where we were, and that's good, and that's exciting.
I think you wrote it in a column, which is basically that 80% of what you write is you've written before. You just have to repackage it so people can understand it in a different way.
Yeah, that's about right. I mean, I was being a little self-deprecating, I guess.
No, you.
But look, the simple truth is that much of what changes is just an illusion, and there's a huge industry both in Wall Street and surrounding it dedicated to the principle that the financial markets are like sports, and it's really all about who's ahead and who's behind, and who's winning and who's losing, and who made an error, who fumbled, who threw the Hail Mary, and this sort of sports mentality of winners and losers is really toxic for consumers, because as an individual investor, what do you care whether somebody else is making more money than you on Tuesday? That money doesn't come out of your pocket.
Okay, we'll be back with our interview with Jason Zweig in just a minute. If you've got a financial question, don't forget you can always email us. Ask Jill at jillonmoney.com. Ask Jill at jillonmoney.com. We'll be right back.
.401ks, IRAs, refinancing, she covers it all. Back to Jill on Money with Jill Schlesinger.
You're back. It's Jill on Money. If you've got a financial question, this is the place for you. We can help answer any of your questions. We are talking about investing right now with our guest, Jason Zweig. But There are so many other things that are going on in your financial life. We're actually going to have another tax filing deadline ahead of us. It's just around the corner, July 15th. We also know that there's tons of people who are struggling to make really important real estate decisions right now. Interest rates are low. Should you refinance? Should you be sending your kid to a $70,000 a year college if that's just online? Answer no. I know that was an easy one to answer. But we're here for you, and Mark and I like receiving emails about a variety of topics. So please don't hesitate. The email address is askjill@jillonmoney.com. Askjill@jillonmoney.com. Well, this is the last segment with Jason Zweig, the columnist and the author. One of the books that I love that Jason has written is called The Devil's Financial Dictionary. It is sort of a black humor approach to understanding some of those terms in the financial world that you've probably been hearing about for a long time. So here is the conclusion of our interview with Jason Zweig.
It's not a zero-sum game. I don't lose if Jill wins, and Jill doesn't win if Jason loses. I win when I stick to my game, and I don't try to play your game. And most of Wall Street's propaganda and most financial journalism, frankly, is dedicated to the proposition that you should be playing the same game as the professionals. And with the tools that are available to you now, you can beat the professionals at their own game.
Mm-hmm.
But think about that for a minute. The professionals have been playing their own game for decades, and they can't win their own game.
Right.
So why would I want to enter a game that the professional players lose in the delusion that I could win? I don't even want to try because they're no good at it. So why would I assume that coming from the outside, I'd be better at it? And more importantly, why play? Why do I want to play a losing game?
But, the thing is that the industry and the propaganda and the financial journalism out there doesn't give you that second piece of information. That's the other part. They say you can beat the market, even though most people don't. They always forget about the second part of that. Right. So one time early in my TV universe, I was a guest on Fox Business News, and I made a comment on air, which I said, I just think it's nuts. I don't know why people just don't buy the index fund and go to sleep. And a guy bit my head off. Like, I almost got killed on air. Like, you are a snob. You think that investing's only for rich people and that little guys can't beat the big guy. I said, no, I just don't think anyone can beat. The big guy is the market. And so you want to go out and sell this belief that one could beat, which, yes, as we said earlier in this interview, anyone can beat the market at any given time. An ape throwing darts can beat the market at any given time. But over the long term, that's not it. Actually, we have proof that shows that over a long period of time, it's awfully hard to consistently beat the market. So that's the part of the industry that I can't stand, is not just that you sell that, but that you don't give someone all the information they can actually make a decision.
Yeah, and I think there's another level to it also, Jill, which is at least as important, which is if I had the choice between beating the market and meeting my goals, I would pick meeting my goals any day of the week. I mean, why is beating the market so important? I mean, let's say we go into a 10-year period where the market doesn't go up anymore. It goes down. Obviously, the only question that matters is not did you beat the market, but did you meet your goals? And why would meeting your goals be dependent on beating the market? I mean, if I want to have enough money to retire or enough money to fund my kids' college education, it might not hurt to beat the market. But if I take so much risk in the attempt to beat the market that I wipe myself out, then I don't meet either of those objectives of beating the market or meeting my own goals. So you always have to think about risk as well as return. And you have to make sure when you set goals that you know why they're there. And a goal of beating the market in isolation is meaningless.
Last question. What's the worst money, I'll give you another one, or career mistake you have made? Because I'm a big believer in human capital. You hear that audible sigh? I like that.
So, Oh, I know. I do know. In 1992, when I became the mutual funds editor at Forbes magazine, I decided not to put the maximum amount into my 401k to get the maximum company match. Forbes had a very generous 401k match at that point, and I said, no, I'm not setting that money aside because I can do better.
Oh, the old I can do better.
And about 10 years ago, I went back and did a very rough, it was just a back of the envelope calculation of what that decision had cost me. And it was about 10 years ago, and it was about $250,000.
Oh, can't go back though. But that is, so max out and get your match. That's a big one.
That'll
catch your attention.
Yeah.
Thanks so much to Jason Zweig. That interview was taped a few years back, but boy, he is as smart as ever. Check out his column. It's in the Wall Street Journal, or go to his website, which is jasonzweig.com, and you can read all about the Devil's Financial Dictionary. Why don't you order it? Why don't you just buy that? It's a fun book to have, and it's got a great cover. Okay, when we return, maybe one more question before we sneak out for the week. You're listening to Jill on Money. We'll be right back. You're back. It's Jill on Money, and just want to remind you that we are broadcasting from the Policy Genius virtual studios. Policy Genius is the easy way to compare and buy insurance. All you have to do is just go to policygenius.com. Very easy, right? Policygenius.com. All right, before we finish the show, after you've now gotten all this fantastic advice from Jason Zweig, just want to do one last email from Judy, who writes that she has just received a sizable inheritance, and we are unsure what is the best place to put our money, especially with interest rates so low right now. We need it to be accessible for home improvements and travel, so don't want any long-term options. We are retired and ready to have some fun. Okay. I guess you want all of it accessible. Interesting. Okay. Well, first things first. Please tell me that out of this inheritance that you'll make sure you've got your 1 year of your expenses just set aside. Okay? Isn't that easy? Just do a year. Now, the second thing, do you have all your debt paid down? Not necessarily mortgage debt, but anything else that's out there, credit card, auto loans, all that stuff. And then finally, any money that you think you're going to need in the near term, say those home improvements and travel are going to take place, maybe not this year, but maybe by next year. That's really going to be a higher yielding money market account, just so that you can get access to it. Maybe it's a higher yielding savings account. You can find those options at depositaccounts.com. Depositaccounts.com. And if it's more than, let's say, 18 months or so, perhaps what you might want to do is buy some longer term CDs. You'll also find those right there at depositaccounts.com. So check it out. And Judy, if I'm missing something or you've got more information that you want to add, feel free to follow up this message with another note from you. And for everyone else listening, we want to thank you again. Don't forget, you can always go to the website, jillonmoney.com. You can read, you can watch TV stuff, you can find our resources, sign up for our free weekly newsletter, and of course, you can listen to past shows. Don't forget, we're here all week long. Ask Jill at jillonmoney.com. Stay safe, wash your hands, wear your mask, maintain your social distancing, and we'll talk to you next week.